Welcome to the Rick Helps Real Estate Show, where after a while, the little voice in your head says, why am I watching this? Good morning. Good morning from Arizona. Little sound check here. Make sure everybody can hear me. I don't know why I asked that. I only had that problem once, but you never know. So, hey, it's supposed to be almost 80 degrees here today. And I can't believe it's Monday. And for those of you that don't live in Arizona, this is actually the beginning of barbecue season. We start getting in the mid 70s, start approaching the 80s in March. And I bought one of those green eggs. It's called a mini egg. Real thick ceramic, the big lid that comes up, and charcoal. I'm telling you, I made some killer chicken last night. Love this time of year. I used to work for a bread company. I was a director of sales out here for Oro Wheat Bread. And we would have these national people in marketing that would come out and kind of put together what we had to have on sale. And I told them the 3 words I didn't want to hear were summer bun season. In other words, barbecuing in the summer. So I would always invite them to my place. Say, hey, come on out in July and, let's barbecue some hamburgers. I'll be inside. You go outside and make the hamburgers. So it was tough. So woohoo, I made it to the live stream. All right, ET, great and welcome. So got a few things to go over this morning. We're going to focus a little bit on interest rates because it's been a wild week and it's going to be an interesting one to watch. I'm looking at the stock market today and it's going down. And I wouldn't say it's tumbling, but it's got a lot of red in it. Bitcoin went up to almost $60,000 on Sunday of all times. And then I think now it's already down to 52,000. So who would have thought you would say that? Bitcoin's down to 52,000. So where are we at today? Well, here we go. The more things change, the more things look the same. We're down to 4,468 active listings. The Cromford report describes it best, I think. And, because like me, they're struggling to figure out what you can even say about this anymore. So here's what they say. I'm going to go back to what they say, and then I'm going to show you that chart. They go, it's hard to explain to people just how bad the supply of the resale market has become in Greater Phoenix. Now, people talk to me all the time, and they go, wow, you must be really busy. We're not. We're not really busy because we can't find anything for the buyers. And it's not that buyer traffic is exploding. It's just that if you look at an individual house that's for sale, there's a lot more people going to that home. So you got like 10 people that want that home. And so it appears busy. You'll see an open house, you'll see 200 people at it. But the number of buyers, while it's up slightly, it's not rocking our world. Anyway, they say the reality is quite difficult to grasp unless you're trying to buy one. Many people mistakenly think demand must be exceptionally high. There we go. But that is not really the issue. It's above average, but not unusual. Not only is the supply extraordinarily low, it has dropped to a large percentage since the beginning of the year. In a normal year, we would expect to have more available supply in February than we had in the start of the year. For example, in 2015, active listings grew from 22,879 in week 1 to 24,000 by week 8. This excludes UBC or CBS. So like I've said, I don't count the ones that are under contract. This is a 5% increase. Well, in 2021, we started the year at 6,113, and by week 8, we've dropped to 4,731, a decline by 23%. This is unprecedented. If active listings were a species of animal, they would go on the critically endangered list. I couldn't agree more. Let me show you what they're looking at here. And when I look at this chart, so here's today. We're down here. Normally in February, we start going up. But in the past 2 years, we've been coming down. So we're just down to nothing. And that's pretty rough. Let's go back to 2006 and see what that chart looked like. Ooh, look at all them homes that were out there. 45,000. Okay, bubble people. This is why there was a bubble. While everybody was out buying and they were buying homes that they weren't moving into, we had 45,000 homes on the market. That's, compare that to today. And then the big crash of 2008, let's put in 8 and 9 in there. Okay, you get down 2009, things started sliding down, right? Everybody was selling their houses, getting out from underneath it. Well, they were actually giving them back. But, inventory was an issue back in the bubble years. It was tough, tough, tough. So how do you deal with that now? And what's the best course of action? And I think the best course of action is you could wait to try and hope that things get to normal. Because let's face it, 4,400 homes, we're not going to stay there forever. It's just not going to happen. It's statistically not possible that we're going to hit this magic number of 4,000 listings and we're going to be there until August. So I just don't see that happening. However, what I do see happening that's happening right now is prices are going to go parabolic. They're going to go nuts. They're going to go like Bitcoin. When there's enough buyer traffic and there's nothing available, the prices have no choice but to go up. There's nothing we can do about it. And they're going to go up in this, what are we sitting here in March? They're going to go up February, March, April, May, and maybe we'll get some relief in June, but I doubt it. We need a spike in availability in order for prices to come down. And that means that we're going to need, let's see, I'm trying to show you the chart here. Here it is. We're going to need this blue line. I'm going to zoom in here. Well, I thought I was. Zoom, 200%. Come on, there we go. Okay. This wonderful line here, the blue one is number of listings that are coming up, and this is the number of homes that are going under contract. Until this line gets above this line, prices aren't coming down, folks. And when did we see that last time? Well, we saw a little bit here right before the holidays, and that was it. And we've been tracking these for a long, long time. When you look at the actual numbers on this busy little eye chart that I have here, you're seeing that we have 3,828 homes that came on the market in the past 70 days, and we put 4,110 of them under contract. So that's the big problem right now. Now, the other thing that we see is what happened to interest rates. And there's an interesting article here. It says it's time to wake up when it comes to rates. Now, but wait, Rick, I thought the Fed controlled the rates and said they're going to keep it down. Well, they're controlling the overnight, folks. And the one thing that I've always kind of held out there, it said, we are at historic lows and we may have lower interest rates next year, but it all depends. It all depends on how the economy's doing. The reality is that the economy is doing poorly and the stock market's not doing great. People will put their money in a safe haven. They'll put it in treasuries. And they'll put it in bonds, And right now they're buying treasuries like crazy. And you can see this chart that it's going up and it's spiking up. So while the Fed says they want to remain low, the treasury market's going nuts. And you can see here that it just spiked this week. Boom. Here's the trend. It's not coming down. So this is putting upward pressure on interest rates. And what he says, he goes, there's no magic rule that says treasuries have to stay inside these red lines, but this sort of breakout can be a cue for traders to intensify selling pressure. In other words, that upper line was a trigger for yields to move even higher. But wait, I thought the Fed said it was keeping rates low for years. What happened to that? The Fed sets the fund rates, not mortgage rate. The Fed's fund rate is a super short-term rate, overnight in fact. 10-year treasuries, on the other hand, last 10 years. The average 30-year fixed mortgage lasts between 5 and 10 years, depending on market conditions. In other words, your 30-year mortgage, you're usually not keeping it, 30 years. Investors place different premiums on rates with different terms. Simply put, the Fed funds rate is indeed still at rock bottom, but longer-term rates are not. What it means right now is we are starting to see what's happened in a week and a half. Rates go from like 2.75 and 2.89 to 3.1. And this is going to be kind of a problem. If you're out buying a home, it's not a major hike. It's still at record lows. But one thing to watch out for is, if you're looking at new construction and they're 6 to 8 months out, you can't lock that rate today. So you do bear some risk going into that. Now, right now, the economists and the people in the market are fearing inflation. And when they're fearing inflation, they're pushing rates higher. If the data starts coming out that's saying that these inflation numbers that we're seeing are kind of an anomaly, because we're seeing it in productivity, in what I want to say, commodities. And so there's a fear that we're going to, this inflation is finally going to show up because they're pumping in 1.9 trillion with the T in spending. And the president has come out and said that the next bill is going to be almost 3 trillion. Well, that's just utterly ridiculous for the government to spend that kind of money. This is going to be tough. And one of the economists that I read, there's an article in the Foundation for Economic Education, and they kind of say this, and the debt is going to be weighing on us, and it's going to have an impact later on down the road. But in the market, it's going to have an impact on where rates are going to go, and I think they're going to stay below 4. I'm not a mortgage guy. My buddy Pat's probably going to do a much better job of explaining that. In fact, he's really good at looking at the charts. So he can look at a daily chart and he can tell you whether or not it's going to move up or down tomorrow. But the need to temper Congress's big spending ambition was a point of agreement among 3 economists. A lot of Democratic spending proposals clearly go way beyond what's needed to deal with the actual pandemic problem. So I don't think there's an economic case for most of this bill. Interesting. It will merely worsen the underlying public finances without much clear economic rationale, and may even be harming the recovery. In other words, what he's saying is, yeah, they're going to be spending a lot of money, but they're not really throwing it at anything that's going to get things moving. I mean, I'd love to see a great big infrastructure bill come out. Critics are quick to scoff at concerns about the debt and deficits, particularly given the hypocrisy of many Republican elected officials on the issue, but the laws of economics haven't changed, and there's still no such thing as a free lunch. At some point, the consequences of our runaway national debt will become too punishing to ignore. The fuse is lit. I just don't know how long the fuse is. None of this that's going on is going to affect real estate prices in 2021 or, in fact, 2022. We talked earlier on Friday, we talked about the forbearances that are out there. And if all these forbearances come out, and what if only 50% of them put their home on the market for sale? All that's going to do is put our inventory up to a number that we consider normal or less than normal. So I don't see a big bubble and a big foreclosure crisis coming. There are plenty of things in banking and in our debt that can make us nervous over the next 5 years. The government can spend money like crazy right now. It's going to roll up and bite us later in higher taxes and insolvency. There's no doubt about it. But you're buying a home now that you want to stay in. You want to be able to get a payment that you can afford. And you're not really thinking 5 and 10 years out, because none of us can predict where we're going to be in 5 and 10 years. So it's a tough time, and you're doing a lot of bidding wars. Now, how do you avoid these bidding wars? Well, yesterday I was thinking about that, and I thought, when you go into a house and it looks really nice, like the one I was in Surprise this weekend, this thing was beautiful, and great floor plan, all fixed up, and, it just looked like $1 million. Well, guess what? There's 10 people behind you now that like the house too. So it's going to be a bidding war. But when you walk into that room that home that's got great bones, it's on a nice lot, but the backyard looks like crud, and the carpets need to replace, and one of the bedrooms is pink, and the other one's blue, and the other one's lime green. Nobody wants that house. But you should get that house and fix it up. It's only paint. It's paint and it's carpet. And that is going to be very unappealing to the average buyer that's out there right now. And it give you an opportunity to get something that's not going to be a bidding war, and you can have some sweat equity. It's worth pouring the money in. So if you had $50,000 to put into the house that you were going to use for a down payment so that you can avoid PMI insurance, maybe you put a lower down payment and then you use a lot of that cash to fix the place up. You'll be far better ahead. And so that is a way to avoid some of the bidding wars. And I've seen some pretty rotten looking homes out there and they're few and far between. I'll see if I can dig one up here. I think I found one let's see, here's a beautiful example of, and I'm going to pull it up on the screen here. Bear with me. You should be able to see it in a moment. And there it is. Pink walls, really crummy carpet, terrible window coverings. This one is not going to get a ton of bidding going on, except maybe investors that are hoping they can pick it up and do what you should do. Too many buyers right now are letting investors get the equity. Well, they've got the money. But if you have the money and you want to use that money to outbid somebody, maybe you need to use that money to fix up a crummy home that nobody else wants. That's an opportunity to grab something in this market where we know the prices are going to go up because simply there aren't enough homes to buy right now. And you know that. And you know that the prices are not coming down anywhere in the next 6 months just because of the math behind it. Why let the people like Open Door, OfferPad, and Zillow come in and buy these homes and fix them up and then sell them to you? Why don't you come in and just fix them up? Have a good old fix-up party. Invite your friends. Get some sweat equity rolling there. So just a thought, just an idea. When you're looking around and you see something that looks really crummy, you should have a little bell go off and go, ooh, that might be an opportunity for them. You still want to have it inspected. You want to make sure the roof's good, all the bones are good, doesn't have any leaks, the air conditioning works. But as far as the interior and fixing it up, take that opportunity to grab some equity. Now, I expect this week that we're going to see some volatility in interest rates. And I think it's going to be shaking up and down as the week progresses. I know Chairman Powell isn't on schedule to speak. Well, he's on the docket to speak to Congress this week. And, whenever the central bank speaks, everybody listens and makes assumptions. They usually speak in a language that we can't understand, especially Alan Greenspan. He was the best guy for that. So we need to watch that closely. Rates are going to be going from around 2.9 to 3.2, back and forth. Work with your lender closely. Have a conversation about when can we lock? How much is it going to cost? Talk about, are there ways to, Terry, I was wondering where you went. If there's a way to buy down the rate, how much does it cost? I'm offering $800 in credit from closing costs for anything over 400,000, 500 below that. You can use some of that to buy down the rate. And I know Pat's offering a $400 appraisal credit. So that's $1,200 that you can have to help a little bit, and every little bit in this market helps. Until then, folks, have a great Monday and don't forget to go outside.